Hello everyone, and welcome to a very quick video just to talk about the fact that the latest annual GDP growth figure came out today, and we're going to be talking about basically what's the deal with it, because annual GDP growth jumped up to 9.6%, which obviously when our goal for strong stable economic growth is to have the total value of production increasing at a rate of 3 to 3.5% real GDP growth per annum, that's 6% above the top end of that target. So is that going to lead to unnecessary or unwanted inflationary external and environmental pressures? Well, let's talk about that and why this 9.6% is actually more of an outlier and less important to dwell on in the short term, and how it's going to be important to talk about it in specific ways in the end of your exam. So let's have a look at the annual rate of GDP growth. So as you can see, over time, it has shot up recently. We only just got positive in the last quarter, but our annual GDP growth is basically, when we are looking at that, it's the last 4 quarters of growth added together. And when we had our negative rates of growth last year, it's taken a while until we are basically 12 months past that. So essentially what this means is we are comparing this to a year ago, which is here. And so the swing is actually very different, because we're comparing an economy that shrunk to an economy that started growing again. And it leads to an extreme swing that might not necessarily mean that we've grown an insane amount. And we'll get into why, the comparison of that later on. So if you look at the quarterly GDP growth changes, so when we look at the annual rate of GDP growth, like I said before, it's just the 4 quarters added together. So as you can see, when we've been looking at GDP growth recently, we've been including this negative 7% for the last few times that we've counted it. And so for the last quarter, when we had 3.6%, 3.2%, and 1.8%, we then had to take negative 7 off of that. So it made the growth rate look pretty small, because it was like we were looking at like 1.6, which ended up being 1.1. But we were looking at a smaller rate of growth. Whereas now we are looking at these 4 added together, which is how we end up getting that 9.6%. These don't necessarily add up exactly to that, but that's basically how we get that 9.6%, because the last 4 quarters added together. And that makes it seem gigantic, even though we are growing by that amount compared to the massively shrunken economy. And how this then gets accentuated and making a lot more sense when you look at it in dollar value. So if we look at GDP growth in terms of US dollars, if you look at 2020 compared to 2021, we have barely changed. And as you can see in 2020, we dropped heaps compared to 2019. That's that negative 6.3% annual growth that we had, is largely because of that massive drop. So now we're increasing, but only in comparison to 2020. So we're slightly up, like we're probably in about 1360, probably something around that based on those changes, probably even less than that. But it means that although we have grown compared to last year, we haven't grown a lot in compared to previous periods. So like GDP has shrunk a fairly significant amount since previous periods. And we're only just starting to recover from that and move forward. So it's going to be really, really important in the end of year exams. We got to talk about this in terms of the fact that it's the economy bouncing back from the shrinkage of growth that we had in 2020. And it's us returning to the levels of growth we were at and slightly above that. It's also probably going to be important to talk about that this 9.6% is kind of going to be an outlying piece of data, because what's going to happen is that this accounts for the last 3 months, which essentially is when we started locking down again. And so this most recent quarter, like September onwards, we've been locked down. Like we're going to be looking at very, very different data, where New South Wales and Victoria have been mostly locked down for this next quarter of time. And our GDP growth, our overall production is going to be greatly negatively impacted by that. And you can also look at that with unemployment figures as well, the looking at future periods and the fact that that's going to be significantly changed because of it. So when you talk about this in terms of the goal being achieved or not achieved, we're probably not going to be too focused on it being achieved, or we're not going to be worried about inflationary pressure because of this, because we know the economy is slowing down right now and it's going to fall. So we're not going to be worried about this being unsustainable or causing inflationary pressures or environmental pressures, because we're only just bouncing back to where we were before the pandemic. And so that's essentially it for why GDP growth has gone so wildly up to 9.6%. I hope this has been useful for you. Thanks for coming to my TED Talk about one individual, very specific piece of data. It's September 16 at the moment. If you haven't already, feel free to sign up to my revision lecture at www.therunningeconomy.com. There's one on the 30th of September, one on the 1st of October. It's only $20. Feel free to sign up and find out many things about the economy. All the up-to-date data at the time is going to be updated in that presentation. On that, I hope you have a wonderful day, and I'll see you next time. Bye.